Hey guys, welcome back to another video by Fully Informed Trade, or FI Trade for short, knowledge for everyone. My name is Alex Cho, and right now I'm going to be talking about the Euro US dollar currency pair. And right now the Euro US dollar was able to have a nice little bounce off that support area that I did mention on Thursday, and I also mentioned on Wednesday, I believe, as well. And basically this support area did hold up. The market did have a pretty decent bounce, and this significant bounce is enough to make the dollar market pull back, and once the dollar pulled back, the broader stock market and the commodity markets did have an explosive move to the upside. So all things considered, this could be seen as a temporary bounce. You could have a couple more days worth of gains, and the stock market could have a cheer rally. But this all comes back to what I was talking about previously, where the stock market continues to consolidate between a very, very broad range, and that it's probably better to try and trade specific stock setups, specific setups within the commodity markets and stuff like that, and use the currency pairs as more of a guiding post. Overall, though, I'm quite pleased to see this area hold up. It was a pretty good area to be a buyer for the Euro US dollar, and I think that it could head just a little bit higher before it tends to fall even further. And the main reason why I think the Euro US dollar is continuing to fall, and I think that it's going to reach parity, is because the European Central Bank really doesn't have much alternatives in terms of what they can do fiscally or in terms of monetary policy. Fiscal policy is pretty much dead in Europe. The fiscal side, I don't even want to talk about it because they really don't know what they're doing. But the monetary policy side, it's basically going to be all about lowering the European Central Bank prime interest rate, and it's going to be lowered to levels that are going to be equivalent to what the Federal Reserve does. And it wouldn't be surprising at all to see the European Central Bank do some huge asset injections, like bigger than what they've done with LTRO. I'm thinking that they're going to do something much larger than that if circumstances do become that much more dire. And the main reason why, I think 3 to 5 trillion euros would be sufficient is because there's so much, there are so many assets on the books of many banks. There's so many assets out there, right? But they're not very liquid. The main asset you could call an asset would be a house, and a house being the fact that it has a lot of value. Okay, houses represent a huge portion of value, disproportionately so, but that's the only thing people are willing to lend money on, which is a house. Hence the reason why houses are so expensive in nature. But houses are very illiquid. Even though they have a lot of notional value to attach to them, when they lack liquidity, the prices of houses tend to fall. And this is kind of what comes back to macroeconomics, where if you don't have enough circulating currency, or N3 currency, basically the currency that's created, if you don't have enough currency floating around, chances are the liquidity of major tangible assets do fall. The liquidity of stocks fall, and once you lose liquidity, consumer demand drops, jobs are lost, and home demand also drops as well. So it's very important to have a pretty big amount of currency. And the main reason why the Euro US dollar is so valuable, why it's at 1.22 rather than parity with the US dollar, is because there's a scarcity of the euro within the European Union and in comparison to the US dollar. So the way I see it is that for Europe to at least fix some of their problem would involve a huge round of quantitative or LTRO, quantitative easing, basically, the way we interpret it, and it would require a lot more than what they have ever committed in the past in history. It is going to be the largest amount you will ever see in quite a while. You'll see a huge number. It's going to be worth trillions of euros. If things get bad enough, it's going to be worth trillions of euros, and that's going to make the Euro US dollar plummet. It's just going to plummet. So that's just what I see in the Euro US dollar. I think that policy action, the Federal Reserve, or no, the ECB, is going to react, and they're going to react very, very, they're going to have a very, very robust response if things get much worse than they already are. And that robust response will include extremely low interest rates, similar to what you see in Japan. Also, those interest rates will be held for maybe a whole decade if things get bad enough, and a huge, huge injection of capital into the economy, similar to what we saw with the quantitative easing, but on a much, much larger scale. So take care, folks. I hope you guys have a wonderful week. I hope you guys make money every single day of the year. So take care.